Well, the Fed chairman covered a lot of ground in his congressional testimony today. Let's take a closer look now with Robert Brusca, the chief economist at FAO Economics. Thank you for joining us.
Thank you.
So let's start with your reaction to Powell's testimony. What do you think were the biggest takeaways?
I think, first of all, he sounded very decisive about heading for a rate cut. It really seems like he thinks that everything is lined up and it acted very decisively like that was important. The other thing that he said kind of surprised me, where he answered a question by saying that the Fed had enough ammunition to do the job that it needed, and that it was really committed to hitting its 2% target in order to make sure that the United States didn't get into a situation like Japan where deflation developed, because the Fed really hasn't acted like its inflation target is terribly important. Every time the inflation rate gets up near the 2% target, the Fed continues to raise rates, doesn't slack off. Seems like it's worried about how there's going to be overshooting. So the Fed hasn't really acted like it wanted to make sure that inflation got to and stayed at 2%.
So then with that being said, we know that Powell said that growth is expected to remain solid. Consumer spending has been steady. But then when he was asked about June's strong employment numbers and whether that would change the Fed's outlook, he said no. So give us an idea on what factors really carry the most weight right now in deciding the pace and the size of the rate cuts.
Well, I think people make too much of this fact that he didn't think that the June employment report changed his mind, because the previous report was so weak that even with June, the year-over-year growth rate has declined quite a lot. So, I mean, if you take a look at these things, you take a look at hours worked, you take a look at all these statistics, even with that bounce back in jobs in June, you have a clear slowing trend in the labor market. So that's why it didn't change his mind. It didn't change his mind because it didn't really change the trend, and the trend is slowing.
So then a lot of people obviously hang very heavily on each word that the Fed uses and how it's sort of nuanced. How has the Fed's economic analysis changed since lawmakers heard from Powell back in February?
Well, I think it's mostly that the economy has changed, and also the fact that the yield curve continues to be very flat. In fact, on today's news, what happened is the yield on the 2-year went up and the 10-year was unchanged. And so the yield curve actually gave up some of its inversion, looking at the coupon curve, the 2s to 10s. So you have a Federal Reserve that is looking at markets that are behaving differently, particularly the bond market, and the Fed is taking note of that. They're aware that this inverted yield curve is not the healthiest situation to have, and that it signals that the economy is fragile, and the Fed has had to make policy more carefully because of that.
And it can be a little confusing because you know that President Trump is often touting the U.S. economy's strength and its growth rate. But then, as you mentioned, Powell did spend a lot of time talking about some of these risks and the headwinds the economy is facing. So overall, how would you characterize the health of the U.S. economy?
Well, I think the economy for now is doing fine. But there are a lot of risks. And the recovery is old, and expansions don't exactly die of old age. But when they get older, you have to be more careful with them. And I think the president, of course, is just, it's all Madison Avenue, right? The president is just saying what you want to hear about how great the economy is. The economy has done better on his watch, but now there are some risks, there are some challenges. And, the irony is that if the Fed's going to cut interest rates, it's going to do it, not because the economy is great, but because the economy is getting weaker. So the president should bite his tongue a little bit and be careful what he wishes for. He doesn't really want to get it.
Now, we know that the trade war featured prominently as one of these threats to growth, as expected. How largely does that loom versus, say, other pressures on the economy domestically and globally?
Well, it's important. It's an important headwind. It's important because we don't know when it's going to be resolved. It's important because it's uncertainty. And with uncertainty, people basically tend not to act. You don't know what's going to happen. You can't handicap it. So you put it on hold. And then you put investment plans on hold. That's not good for the economy. So that's very important. And then, of course, that has knock-on effects into what you might consider the purely domestic economy. If you're not investing and if people aren't hiring as much, it just affects the whole economy. And after a while, you can't disentangle the domestic economy from the international economy, and it's all weakening together. And I think that's the situation they're concerned about, and they don't want that to happen.
And once again, of course, the issue of the Fed's independence came up. We know that last week Trump tweeted that he called the Fed America's most difficult problem. And Powell was asked multiple times by lawmakers if he would step down if pressured. He repeatedly said no and he'd serve out his term. But is that enough to put this issue of the Fed's independence to rest at last?
Well, the Fed is independent. Mr. Powell is clearly going to remain independent, and this is just a given. I mean, Mr. Trump can tweet, and he can bluster all he wants, but he can't change it. So I really think it's just kind of embarrassing. You know, the more the president does this, it's embarrassing because, you know, he's aiming an empty gun. He can't do anything. We know he can't do anything. And if he tries to do something, he's only going to embarrass himself. And so I think of it as embarrassing.
All right, thank you so much for your insights. Robert Brusca there, the chief economist at FAO Economics.